Hi dear students, this is CAT course offered by St. George's College, Arivithra. This is paper 1, Fundamentals of Financial Accounting, video session number 8. In this session, we will be discussing about capital receipts and revenue receipts, capital profits and revenue profits, capital losses and revenue losses, counting standards, the concept of journal, subdivision of journal, and what is a compound journal. So let's start discussing the first topic, that is capital receipt and revenue receipt. So in accounting, the word capital always denote a long term item and the word revenue always relate to a short term item. So let's discuss what is a capital receipt. So you know the word capital indicates this is the amount which is contributed by the owner into the business. Similarly, capital receipt means it is the contribution of fund which is received from the proprietor towards the capital. So any amount which is brought into the business by the owner or any amount which is brought into the business by someone else outside the business, both are considered as capital receipt. So receipt here means it is received, the amount is received. It may be either received from the proprietor or it may be either received from the person outside the business. Such type of money is known as the capital receipts. So the capital receipt do not have any effect on the profit because it won't be entering into your profit and loss account. So it will not have any impact. It will not at all affects the profit or the loss values. Such type of long term receipts which is having a long term impact, that is known as the capital receipts. Now the second one is, what do you mean by a revenue receipt? The revenue receipt means this is also the money received, but the money is received from the customers against the goods supplied to them. Such type of receipts are known as the revenue receipts, and they are short term in nature, they are recurring in nature. Such type of receipts are known as revenue receipts. And the main impact of revenue receipt is that it may either increase the profit or it may be decreasing the profit values of the business. Such type of receipts are known as revenue receipts. So once again, capital receipt means received from the proprietor, it is non-recurring in nature, or it may be received from outsiders and it may be of long term value. Such type of receipts are known as capital receipts and it will not have any effect on the profit or loss values. But the revenue receipt means that are received from the customers, they are recurring in nature, the value will be generally considerably low and it will have an impact on the profitability as well as it may have some effect on the loss values of the business. Such type of receipts are known as capital receipts and revenue receipts. Let's move on to the next concept, that is the capital profits and the revenue profits. So if the profit is generally derived out of the ordinary nature, the transactions which are of ordinary in nature, such type of profits are known as revenue profits. Ordinary in nature here actually means the day-to-day transactions of the business. If the business are or if the profits are generated from the day-to-day activities or the regular activities or the revenue generating activities of the business, such type of profits are known as the revenue profits. And if the profits are resulting from the non-recurring transactions, they are not regular in nature, such type of transactions are known as the capital profits. So the capital profits non-recurring, but the revenue profits are derived from the recurring activities of the business. Now let's see some of the examples of the capital profits. You have already said the capital profits are non-recurring transactions, like the profit from the incorporation of the business, like starting of the business. Then the premium received on issue of shares, they are non-recurring. Then the profits made on the reissue of forfeited shares, the cancelled shares when it is reissued, the profits derived, that is also a capital profit. Then redemption of debentures at a discount, usually it should be paid at the par value. If it is a discount, we are generating some profit. And the profit made out of the revaluation of fixed assets. When you look into the glance, you can identify that these transactions are not at all regular. They may not happen regularly in the business. If the profits are derived from these values, then that is generally known as the capital profits. Now moving to the next concept, that is the capital losses and the revenue losses. Similarly, what we have said in the profit values, the profit which is generated from the normal course of business is known as revenue profit. Similarly, what is revenue loss? The losses which is derived from the normal course of the business, then that is known as the revenue losses. If the business is having their own operating activity, and if the loss is derived from those operating activities, then that can be treated as the revenue losses. So it is associated with the customers, it is associated with the sale of the goods, and if it is related with or if it derives at a loss, then that can be treated as a revenue losses. Then what about the capital losses? It may be resulting from the non-recurring activities, mainly from the sale of the assets, or in connection with the raising of the capital, or in connection with the settlement of the liabilities. Such type of losses are known as the capital losses. So they are non-recurring, like sale of assets. The sale of asset may not regularly happen in the business, and if the loss is derived from the sale of the asset, that can be treated as a capital loss. Or at the time of raising the capital, like we are raising the capital by issuing the shares at a discount, such type of reduction in value can be treated as a capital loss. Then what is the treatment of capital loss? It is treated like same in case of the capital profits, which means the amount generally appears in the profit and loss account, which means the value of the profit or the value of the loss, that only will be appearing in your profit and loss account, but the sale values will not be appearing in the profit and loss accounts. So but other capital losses are adjusted against the capital profits. So mainly the sale of fixed assets, whenever the sale happens to the fixed asset, usually those items will be recorded in the profit and loss account. But other losses, like the loss which is derived or the profit which is derived on incorporation, or like settlement of liabilities, that won't appear in your profit and loss account. Generally the profit or loss derived from the sale of assets, that will be only recorded in the profit and loss account. All other profits, all other losses will be adjusted against the concerned capital profit or the capital losses. The capital losses will be adjusted against the capital profit values. So these are the three major topics, like capital profit, capital losses, revenue profits and revenue losses, then capital receipts and revenue receipts. So this is clear, I think. Now we are moving to the next concept, that is known as accounting standards. Very important topic, because accounting standards are generalized principles which are to be followed by every accountants, every business firm for a standardization. That is known as accounting standards. We have accounting standards generally mentioned as AS, accounting standard, and we are also having Indian accounting standards, that is in this table represented as IND-AS. Okay, Indian accounting standards and accounting standards. Some of the major important accounting standards are highlighted here, so you should just note the numbers. The examination, they will be asking you the numbers, which is the accounting standard that represents the inventory. So you should say the number which denotes that particular accounting standard. So now let's see some of the important items, like inventories. The valuation of inventories, in accounting standard it is number 2, and in Indian accounting standard also it is number 2. So there may be sometimes the differences will be there. The next one is one of the important financial statement is the cash flow statement. So in accounting standard it represents number 3, and in Indian accounting standards it represents number 7. Then the contracts, the construction of contracts, in accounting standards it is AS7, and in Indian accounting standards it is number 11. Then what about income taxes? Income taxes in accounting standards it is number 22, and in Indian accounting standards it is number 12. Next one of the important item is related with the leases. Then that is in the accounting standards it is 19, and in Indian accounting standards it is 17. Important. Then about employee benefits like salary, gratuity, provident fund, etc. Accounting standard, it denotes accounting standards number 15, and in Indian accounting standards it is represented by accounting standard 19. Then important one relating to the EPS, earnings per share. In accounting standards it is number 20, and Indian accounting standards it is number 33. So you should generally go through it, all the accounting standards and Indian accounting standards, and some of them are very important in your standards, which will be asked. Rarely 1 or 2 questions may be asked, so that you should be clear with those items. Okay. Next one relating to intangible assets, like accounting standard it is 26, and Indian accounting standards it is number 38. Then about insurance contracts, accounting standards it is not there. There is no corresponding standard. Only it comes under Indian accounting standards 104. Then financial instruments and disclosures, it comes in accounting standard 32, and in Indian accounting standards 107. So generally we can say that there is 33 accounting standards AS. And Indian accounting standards, the number is not that much clearly known. Indian accounting standards, there are splitting is there are different numbers are there. You should mainly focus on to accounting standards, not to Indian accounting standards. Indian accounting standards are also there, that idea should be there, but you will be asked to mention the numbers of accounting standards AS. So I have given some of the major important items. Just go through all these items and find out which is the accounting standard corresponding to it. You can find here around 32 and 33 accounting standards AS, that you should generally go through it. Okay, so that is all about accounting standards. Now let's see why accounting standards are required for a particular standardized procedures. The need for accounting standards. First one, it helps in the dissemination of timely and useful information to all the stakeholders. You know, accounting is it is created mainly for its stakeholders, but the data should be available at proper time, and the availability, if it is at proper time only, it is having some usefulness. So the accounting standards make sure that the data is timely available, and the timely available information is having only some use. So that is clearly ensured with the help of accounting standards. And the second one, it helps to create certain standardized accounting policies. So it should be followed by everywhere and every accountant, so that there can be a possibility of comparison. So to create certain standards, create certain standardized policies, we are having accounting standards. The third one, it ensures that the disclosures of accounting principles and treatments, so it should be properly disclosed, all the accounting principles followed, and the treatments which we are doing, that should be clearly disclosed by the accountants. So that is also ensured with the help of accounting standards. Then it helps to reduce or totally eliminate accounting alternatives, thereby helps in better inter-firm and intra-firm comparisons. So regularly there should be a standardized procedure. That's why we say that it eliminates or reduces the accounting alternatives. If the changes regularly happen to an accounting system, then the firm comparisons may not be possible. So the accounting standard ensures that there is standardized procedure, there is no change in the procedures year to year, so that it helps the accountants, other accountants, stakeholders for inter-firm and intra-firm comparison. And last one, it also reduces the scope of creative accounting, which we can say that accounting process is done by accountants, and it's an art. So there can be creative alternatives for the accountants. The accountants may change the system every time. So the accounting standards ensures that there is no scope for creative accounting. It is not on the basis of the creativity of the accountant we prepare the books of account. No, it is based on standardized procedure. There is no room for creativity here. There are procedures, there are standardized practices. The accountant should follow the practices and should prepare the books of accounts. So that's why we are having the accounting standard. It ensures credibility, it ensures standardization, it ensures reliability, it helps in comparison. So for all those purposes we are having accounting standards. Now we are moving to the next topic, that is books of prime entry. So which book is known as the book of prime entry? That is known as journal. The journal is offered or generally considered as the book of primary entry or the book of original entry. Why it is known as the book of prime? Prime means the first hand entry or the original entry, because all the transactions are recorded into journal for the first time and they are recorded in the chronological order. What is chronological order? Date wise. There is a order for this thing. Date wise every transaction should be recorded for the first time. Whenever a transaction happens, it is recorded in the first time in the books of journal. That's why it is known as the book of primary entry or the original entry. And the process of entering these transactions into journal is known as journalization. That process, the process of entering the transactions, that is known as journalization, and the entries which are made is known as the journal entry. So that is the concept of journal. It is a book of primary entry or the original entry, recording all the transactions in chronological order. The process is known as journalization and the entries are known as journal entries. Now we know there are many lot number of transactions that happen in the journal. If that transactions are recorded, we cannot generally summarize it. So there is subdivisions of journal, and the journals are divided into two: general journal and special journals. General journal means recording all the transactions commonly into one book of account, that is known as general journals. But special journals means there are certain classification. So what are known as the subdivisions of journal or the special journals? It include cash book, purchases book, sales day book, return inward, return outward book, bill receivable book, bill payable book, and the last one is known as the journal proper. We will be discussing these things in very detail in the coming video, the subdivision of journals. Now we need to just know the names: cash, purchases, sales, return inward, return outward, bill receivables, bills payable, and journal proper. They are known as subdivisions of journal, or they are also called as the special journals. Next one, let's see what is a general journal. This is a book of chronological record of transactions. That is simply known as a journal. Here there is no bifurcations. All the transactions, we are not considering whether it is a cash transaction, whether it is something related to purchases, sales, inwards, outwards, bill receivable, bill payable. We are not at all considering that. Every transaction is recorded into this book in a chronological order. So this book records the transactions which occur so infrequently that they do not warrant the settings of a special journal. So here the transactions are recorded regularly, or so if it is not required, not so frequent, those transactions are recorded into the general journal. And such examples which are recorded are opening entries, closing entries, and rectification entries. So we should know what all transactions or type of transactions are generally recorded into general journal. That is, opening entries are recorded, closing entries are recorded, and rectification, generally rectification entries are also recorded. Now let's see what is the format of a journal. We are having a date column. The particulars column, we are entering the transactions of the journal entries, and there is a ledger folio LF, the debit amount and the credit amount. So that is the general format of a journal. Now what are special journals? The special journals means we have already said, that is, in journal there is a heavy load of transactions, and at the end of the day we cannot classify it, or we cannot say what is the transaction or the cash value or the purchase value or the sale value by just looking onto a normal journal. So we classify these into sub books which are normally happening, like cash values, purchases values, sales values, that are known as special journals. So it is known as subdivisions of journal, which means it includes cash book, purchases day book, sales day book, return inwards book, return outwards book, bill receivable book, and a bills payable book. So the special journals are also known as subsidiary books, and we will be discussing it in the coming videos. And coming to the last topic of our discussion today, that is our compound journal. So compound journal means if there are more than one account which is debited or credited, which we can say that for a normal transaction or a journal entry, there are only two aspects. One aspect is the debit aspect and the second one is the credit aspect. Normally your transaction is having one debit and one credit. So if there are more than one debits and if there are more than one credits in a single transaction, such type of transactions are known as compound. More than one, that is known as compound journal. So let's see what is a single transaction. A single transaction is one in which one account will be debited and one account will be credited. Such type of transactions are known as, or journals are known as simple. One debit, one credit. But if there are more than one account debited and more than one account credited, then such type of accounts are known as compound journal. More than one debit and more than one credit. Such type of transaction comes under compound journal. So some examples: started business with the cash, planned and stock. So what will be the journal entry? Cash is brought in, so cash account will be debited. So okay, and planned is another asset, so that comes in, so that also will be debited. And the stock is also a current asset, so that also will be debited. So these items will be debited, and the credit goes to, it is started the business, so the credit goes to capital. So let's see the journal entry. Look onto the journal entry. 3 items are debited and 1 item is credited. So if it is there more than one item, either in the debit or in the credit, that can be classified under compounding journal. So these are the topics of our discussion for this session. So you should go through all these things. Examples are given in your textbook. Go through it thoroughly and read the transactions and read the entries which is given in as a part of your examples. So give a clear idea about the transactions or items related to journal, subdivision, etc. So hope to see in the next video. Thank you.